In 1877, Cornelius Vanderbilt died as the richest man in the United States. His estate was worth an estimated $100 million, roughly $3 billion in today's money. He had built railroads, steamships, and an empire that seemed unshakable. By 1907, not a single Vanderbilt appeared on the list of America's wealthiest families. By the time his descendants gathered for a family reunion in 1973, by one account, not one of them was a millionaire. 3 generations gone. Now consider the Rockefellers, still a name of consequence 6 generations later. The Rothschilds, managing hundreds of billions across 7. The Phipps family, whose quiet wealth management structure became one of the most powerful financial institutions in the country, and most people have never even heard the connection. What did they know that the Vanderbilts didn't? The answer isn't luck. It isn't a better stock pick or a smarter investment strategy. It's a set of codes, 15 of them, that these families practice consistently and almost never speak about out loud. By the end of this, you'll understand exactly why the silence is the system. Number 1, they never discuss money in public. Walk into any gathering of genuinely old money and you will not hear a conversation about net worth, investment returns, or what anything cost. Not because they are modest, because they understand something that most people never figure out. Information about your wealth is a negotiating position. The moment you reveal it, you have weakened it. This rule has deep roots. In the aristocratic circles of 19th century Europe and the gilded drawing rooms of old American families, discussing money was considered not just impolite, but vulgar in the original sense of the word, common. The families who had held wealth for generations understood, intuitively, that the conversation about money was itself a class marker. The newly rich talked about what things cost because cost was still something they thought about. Those who had held wealth long enough no longer needed to. But behind the social propriety was something more strategic. These families had learned, across generations, that revealing financial information was a form of exposure. If your counterpart in a negotiation knows how much you have, they know how much to ask for. If your neighbors know what you paid, they form expectations. If the public knows your worth, you become a target. For causes, for litigants, for people who believe your abundance obligates you to them. Children in these families absorb this early. You do not ask what someone paid for their home. You do not volunteer what your father earns. You do not discuss the size of an inheritance or the terms of a settlement. The truly wealthy communicate status through understated signals, objects and behaviors recognized by those inside the circle and invisible to everyone else. The irony is that the people who talk most openly about money are often the ones with the least staying power. New money announces itself because the announcement is part of the satisfaction. Old money stays quiet, and staying quiet, it turns out, is a meaningful part of how it stays. Number 2, every child learns to keep a ledger before they understand what money is. John D. Rockefeller Jr., son of the richest man in American history, gave each of his 5 children an allowance of 25 cents a week. Not because the family could not afford more, because the amount was never the point. Every child was required to keep a personal daily account book, 10% to charity, 10% to savings. Every remaining cent tracked and justified, with the books balanced at the end of each month. If a child wanted more than the allowance provided, the path was clear: earn it. Nelson Rockefeller, who would go on to become Vice President of the United States, grew vegetables and raised rabbits to sell back to his own parents. Think about what that system was actually teaching. Not budgeting in any technical sense, not financial literacy as it is marketed today. What the ledger installed was an identity, the identity of someone who accounts for every resource that passes through their hands. Someone for whom no transaction is too small to notice, no outflow too trivial to record. That identity, built into a child before age 10, does not disappear when the amounts get larger. It scales. The same attentiveness that tracks 25 cents per week, applied to 25 million, becomes a fundamentally different relationship with capital than the person who never learned to pay attention at all. These families did not believe wealth could be handed to an heir intact. They believed it had to be installed as a way of thinking, and that the thinking had to come first, long before the wealth that would eventually test it. The way you handle 25 cents is the way you will handle 25 million. These families understood that long before most financial advisors thought to say it. But the silence is not just social. It has an operational dimension most people never suspect. Number 3. They use silence as a weapon in every negotiation. Most people think of silence as the absence of strategy. These families treat it as the strategy itself. John D. Rockefeller Sr. built the largest corporate empire in American history, in part through a mechanism so simple it bordered on invisible. The Standard Oil Company acquired competitors not under its own name, but through subsidiary companies with no public connection to Rockefeller. A rival oil refiner would negotiate a sale, close the deal, walk away believing they had sold to a regional buyer, and only later realize, if they realized at all, that they had sold to the very empire they were competing against. The silence was not deception for its own sake, it was asymmetry. When your counterpart does not know who they are dealing with, they cannot price accordingly. When you do not reveal your position, they cannot prepare for it. Rockefeller understood before the concept had a name that information withheld was power retained. He extended this principle to his own public profile. He believed, with genuine conviction, that weak men had loose tongues and spoke freely to reporters. Prudent men kept their own counsel. For decades, that was Standard Oil's official posture toward the press: total silence. When investigative journalist Ida Tarbell published her landmark series on the company beginning in 1902, Rockefeller did not respond. The company did not respond. The absence of reply, he believed, was strength. In that particular instance, the silence misfired. The public was infuriated by the non-response, and by 1905 he finally initiated a public relations effort. But the underlying principle held across his career. In any contest of information, the side that reveals less controls more. The competitor who knows your full financial position can squeeze you. The competitor who doesn't knows they might be walking into something much larger than they can see. Number 4. They never sell the land. Ask a financial advisor to maximize returns, and they will rarely point you toward land. It does not yield dividends on its own. It does not compound overnight. In a strong bull market, equities, bonds, and almost any other asset class will outperform it consistently. Old money does not care. What land does, what it has done for centuries without interruption, is survive. Currency crises, market crashes, political upheaval, inflation, depression, wars that wiped bank accounts and rendered paper assets worthless have, time and again, left the land standing. The families who held real property through the chaos that erased financial fortunes emerged on the other side with something to build from. This is not sentimentality. It is a studied response to the historical pattern of wealth destruction. The assets that generate the highest returns in a good decade are almost always the ones that are most exposed when the system that priced them fails. Land is priced in something more durable than any currency or financial instrument. It is priced in the fundamental human need for ground to stand on. Families who have sustained wealth across multiple generations consistently hold a disproportionate share in real assets: land, property, physical holdings. The family estate is not a luxury, it is a vault. It appreciates across generations while simultaneously serving as a gathering point that keeps the family connected and its identity intact. And connection and identity, as we will continue to see, are themselves wealth preservation mechanisms. The principle is not that every family should maximize real estate holdings. It is that the asset class that allows you to survive the failures of all other asset classes deserves a permanent place in the structure. These families buy things that survive the collapse of the systems those things are priced in, and then they hold them. Knowing what not to sell is only half of it. The other half is knowing what not to show. Number 5. They give, but they never give for credit. In 1901, when Andrew Carnegie and his partners sold Carnegie Steel, 2 men walked away with the majority of the proceeds. Carnegie received the lion's share. His partner, Henry Phipps Jr., who held 11% of the company, second only to Carnegie himself, received between $40 and $50 million by most estimates. What happened next is instructive. Carnegie became the most famous philanthropist in American history. Libraries, concert halls, universities. His name on institutions across 3 continents. He gave publicly, talked publicly, wrote about his philosophy of wealth in essays that circulated widely, and built a personal reputation as a benefactor that outlasted his fortune by more than a century. Phipps did something different. He refused every interview request. He declined all public statements about his personal life or his charitable work. He gave in private, to tuberculosis research, to psychiatric medicine, to public parks in Pittsburgh, and told almost no one. When he funded the Phipps Institute for Tuberculosis Research in 1903, there was no gala. When he endowed the psychiatric clinic at Johns Hopkins Hospital that bears his name, there was no ceremony reported in the press. When he built Phipps Conservatory and Botanical Gardens in Pittsburgh, now one of the most visited attractions in the region, his name was on the door and almost nowhere else. In 1907, Phipps quietly established a family office to manage his fortune. That structure, built in silence and operated without publicity, eventually evolved into Bessemer Trust, today one of the most prominent wealth management institutions in the United States, serving some of the wealthiest families in the country. Most people who work with Bessemer Trust have no idea that its origin story is a reclusive Pittsburgh industrialist who refused to give interviews after selling his stake in a steel company. Most people have never heard of Henry Phipps Jr. He would have considered that a success. The lesson is not that Carnegie was wrong. Both men gave generously. The distinction is in the architecture of the giving. Carnegie gave to build his reputation. The fortune was essentially dispersed within his own lifetime. Phipps gave to build institutions. The structure he created still manages capital today. Philanthropy as architecture, not advertising. The institution outlives the donor, and in this case, so does the wealth. Number 6. No heir receives the fortune without first earning the right to manage it. The most dangerous moment for any generational fortune is the handoff, not because of taxes, though those matter, and not primarily because of market conditions, because of the heir. An heir who inherits an enormous sum without preparation, without the experience of managing progressively larger amounts, without the identity of someone who has had to account for resources, is not the recipient of an opportunity. They are the recipient of a test they were never trained to pass. The Pritzker family, one of the wealthiest in American history, founders of the Hyatt Hotel empire, built their inheritance system around a direct response to this reality. Wealth would be distributed over time, tied to demonstrated life milestones, not delivered in a single transaction at the moment of death. Under the structure J. Pritzker established, each member of the next generation began receiving an annual income after graduating from college, starting at $100,000 a year and increasing over time to $1 million annually by age 40. Additional lump sums were tied to specific milestones, graduation, turning 30, and others. By age 45, each cousin would have received approximately $25 million in total. The principal trust itself was not to be dissolved until 2042. The structure did something elegant. It gave heirs the experience of managing significant money at a scale that would not destroy them if they made mistakes, then graduated the responsibility upward as their capacity, presumably, grew with it. By the time an heir received the largest distributions, they had already spent 2 decades managing meaningful sums. They arrived at the principle having already become, in practice, the person capable of holding it. You do not hand someone the controls of a 747 without years in a simulator first. These families designed the simulator, and they made sure no one graduated without flying it. Number 7. They build a private government before they need one. In 1882, John D. Rockefeller Sr. faced a problem that very few individuals in history have encountered. He had accumulated so much wealth across so many domains: oil, real estate, philanthropy, legal obligations, family obligations, that no existing institution was equipped to manage it. Banks were too narrow. Law firms were too reactive. Accountants could track what existed, but couldn't plan what came next. No single advisor could hold the full picture. His response was to hire a man named Frederick T. Gates and build something that had no real precedent: the first full-service, single-family office in the United States. Gates described his own role as that of an entirely independent agent. He was a generalist, not a specialist in any one domain, whose job was to oversee the entire operation of the Rockefeller fortune across every dimension simultaneously. Financial assets, philanthropic programs, legal affairs, tax considerations, the education and long-term preparation of the next generation. Everything coordinated under one roof, with the kind of institutional continuity and accumulated knowledge that no outside firm, which changes personnel, changes focus, and ultimately serves many clients, can replicate. The family office is, at its core, a parallel government. It has no elections. It has no term limits. It answers to no constituency except the family it serves. And it carries institutional memory from one generation to the next in a way that external advisors, however skilled, cannot. The Rockefeller family office has outlasted Standard Oil, the Gilded Age, the Great Depression, 2 world wars, and the careers of every individual who ever worked within it. At his death in 1937, Rockefeller's estate was valued at $1.4 billion. By some estimates, a concentration of wealth larger than almost any individual has accumulated since. The family office, established 55 years before his death, managed that fortune through every challenge that arose and carried the structure across generations. The principle is not that wealth requires a family office to survive. The principle is that the institution required to protect wealth at scale must be built before the protection becomes urgent. By the time you need the structure, you rarely have the clarity or the time to build it correctly. These families built it first. Number 8. They make wealth legally disappear without losing control. Here is something that sounds impossible until you understand the mechanics. Some of the wealthiest families in history have transferred enormous fortunes from generation to generation, while technically not transferring them at all. The instrument is called a dynasty trust, sometimes called a perpetual trust, and the logic, once you see it, is difficult to unsee. Under ordinary inheritance, assets pass from parent to child. That transfer triggers obligations: estate taxes, generation-skipping transfer taxes, administrative costs, and the exposure of the assets to any creditor, divorce proceeding, or legal judgment that the heir might encounter in their lifetime. Over 3 or 4 generations of ordinary inheritance, a meaningful fraction of any fortune is consumed by the transfer process itself, before a single heir makes a single decision. A dynasty trust operates differently. Assets are placed into the trust once, then they stay there. The beneficiaries do not own the assets in any conventional legal sense. They do not inherit them at any specific moment. They use them, manage them, benefit from the income and principal distributions the trust provides, but legally, the assets belong to the trust entity itself. And because there is no legal transfer between persons, there is no taxable transfer event. In states like Delaware, Alaska, and South Dakota, these structures can be built to last indefinitely. The wealth is not passed down through generations. It is parked in a legal architecture that exists outside the ordinary rules of ownership. A creditor suing an heir cannot reach trust assets. A divorce settlement cannot split them. The government cannot tax assets at each generational handoff because, legally, no handoff occurs. The Rothschilds have employed variations of this structure for generations. The deeper principle, the separation of control from ownership, is one of the most powerful and least publicized mechanisms in the history of wealth preservation. You can use the wealth entirely. You simply cannot own it in the way that makes it legally vulnerable. Controlling assets is one thing. Controlling perception is another. And these families are masters at both. Number 9. They treat the family name as a balance sheet asset. In the mid-19th century, Caroline Astor did something that no amount of money alone could accomplish. She made the Astor name the defining credential of New York's social elite. Her approval was the gate into society. Her guest list was the standard by which others measured themselves. The Astor name, through her deliberate and sustained curation over decades, became more valuable than the fortune that bore it, because it was the one thing that fortune couldn't simply purchase on its own. For a time, the strategy worked brilliantly. The Astor name opened doors that money alone did not open. It granted access to political relationships, cultural institutions, and social networks whose value was denominated not in dollars, but in influence. It was, in the truest sense, capital of a different kind, reputational capital, built intentionally and maintained through constant vigilance about who the family associated with, what causes it supported, and what behavior it tolerated from its own members. But reputation, unlike a trust fund, requires constant maintenance, and unlike financial assets, it cannot be rebuilt after a certain kind of loss. When Brooke Astor, one of the last great stewards of the family name, a celebrated philanthropist and social figure, died in 2007, what followed was devastating. Her son, Anthony Marshall, was convicted of fraud committed against his own elderly mother, systematically depleting her estate, altering her will, failing to provide for her care while living in conditions that shocked those who witnessed them. The trial exposed in public precisely the behavior that the Astor name had spent generations signaling would never occur. The fortune dispersed. The social influence evaporated. The name today carries history, but no longer carries weight. What Caroline Astor built over a lifetime, her descendant destroyed in a legal proceeding. The lesson the most durable families draw from stories like this is precise. The family name is not an inheritance. It is an asset that requires stewardship as active as any financial holding. And unlike financial losses, which can be rebuilt through discipline and time, reputational losses of a certain magnitude cannot be recovered at all. The next generation inherits the damage, not the resource. Number 10. They never let the fortune fragment. After Waterloo in 1815, the Rothschild family controlled banking operations in Frankfurt, London, Paris, Vienna, and Naples. 5 separate houses that might naturally have been divided across 5 brothers, and then divided again among their children, the ordinary mathematics of inheritance turning one large thing into many smaller ones. They chose a fundamentally different path. In 1818, the 5 brothers formalized a partnership agreement that restructured all 5 houses into what the document itself called one general joint concern. Each house maintained its own operations, its own local relationships, its own staff. But the capital remained coordinated. Decisions of consequence were shared. Intelligence gathered in Vienna informed strategy in London. Resources available in Paris could support an operation in Naples. The 5 houses were, for all financial purposes, one entity with 5 faces. The historian Neil Ferguson identified this 1818 agreement, not political connections, not individual brilliance, not secrecy, as the actual mechanism behind their 200-year run. 5 major financial centers, coordinated as one, gave them a scale and reach that no family operating in a single market could match. Together, they were the largest private bank in the world. Separated, each would have been a regional institution of moderate significance, and within 3 generations, probably a footnote. The Vanderbilt fortune fragmented because nothing held it together. The Rothschild fortune endured because there was a deliberate, legal, structural, and cultural architecture designed specifically to prevent fragmentation. Built while the patriarch was still alive to enforce it, and before the pressures of inheritance had a chance to do what they always do when given the opportunity. Most fortunes do not die from a single catastrophe. They dissolve gradually, across too many hands, with too little coordination, in the absence of any structure designed to resist the dispersal. These families knew this, and they built against it. That system of holding together works across borders, but there is another dimension, how these families hold influence without ever being seen holding it. Number 11. They exercise power without holding office. The DuPont family has shaped the state of Delaware for more than 200 years. The chemical company that bears their name became one of the largest corporations in American history. Their philanthropic institutions funded universities, hospitals, and public gardens throughout the region, and their political and economic influence reshaped financial law in ways that continue to affect how corporations operate across the entire country to this day. Almost none of this required a high personal profile. The family worked through foundations, through institutional boards, through appointments and alliances built across decades, in the way that only old money can build them, slowly, patiently, without any single dramatic move that would draw the attention that personal celebrity invites, and individual power always eventually generates. The face of the family was rarely the instrument of the family's power. The instrument was the structure. Former Governor Pierre DuPont, known as Pete, was one of the more visible exceptions in the family's modern history. Under his administration, the Financial Center Development Act transformed Delaware into the national hub for credit card companies and major financial services firms, drawing institutions that permanently reshaped how banking and consumer credit operate in the United States. That legislation exists and functions today. Its effects are felt daily by millions of Americans. Pete DuPont himself is remembered primarily within Delaware. That ratio, enormous institutional impact, minimal personal celebrity, is precisely what these families optimize for. Individuals have careers that peak and decline. Individuals have scandals, health problems, and lifespans. The family member who becomes famous for their power becomes a target in ways the family member who holds power quietly does not. Durable influence, these families have learned across generations, is embedded in institutions, in foundations whose boards they quietly populate, in legislative frameworks their predecessors helped shape, in relationships with other institutions built over decades of reliable presence. The face changes with each generation. The hand on the lever does not. Number 12. They signal status only to those who already understand it. There is a test that applies to almost everything old money buys. If a stranger on the street would recognize it as expensive, it is probably the wrong choice. This is not false modesty. It is not asceticism or self-denial dressed up as virtue. It is a filtering mechanism, one that has served these families for generations and that functions precisely because most people have never been taught to read it. The brands that carry genuine meaning within old money circles are not the ones with the most visible logos. They are the ones whose recognition is limited, by design, to those who already know. A certain cashmere maker in northern Italy, a tailor on a specific street in London, a jeweler whose name is spoken only to someone who is already standing in the right room. These products are not marked by conspicuous branding because their clients do not want to be identified by the general public. They want to be identified by each other. This is a critically different orientation than the one that drives most luxury consumption. The logo that announces itself to everyone is a signal directed outward, toward people who are not in the circle, intended to impress them. The label that announces itself only to someone who already knows is a signal directed inward, toward the circle itself, confirming membership. What is described today as quiet luxury, the emphasis on materials, construction, and timeless design over visible marking, is not a recent cultural trend. It is the return in mainstream commercial culture to a sensibility that genuinely old wealth never abandoned. The restraint was never about the price. The price is irrelevant. It was always about the recognition, who sees it, and what they understand it to mean. The signal is not expense. The signal is the ability to read the signal correctly. And that ability is itself a form of belonging. You either know or you do not. And if you need to be told, the answer is almost certainly no. Every system has a vulnerability, and these families know that the greatest risk to a fortune is rarely the market, the tax code, or the government. The greater threat almost always comes from within. Number 13. They protect the fortune from their own heirs. There is a well-worn saying in the world of generational wealth. The first generation builds it, the second generation maintains it, and the third generation loses it. This pattern is documented well enough that it has a name in several languages. The families who consistently beat those odds share one understanding that the families who don't have either missed or discovered too late. The greatest threat to a fortune is rarely external. It is not market collapse. Durable fortunes have survived the worst markets in history. It is not taxation, which is real but manageable. It is not even economic upheaval, which the longest-standing fortunes have navigated through depression, war, and the complete restructuring of entire industries. The most consistent destroyer of generational wealth is the heir who was not prepared, handed resources they had no framework for holding. The Vanderbilt collapse, examined carefully, was not the result of any single catastrophic event. There was no fraud on a dramatic scale, no single bad investment that took everything. There was 100 smaller decisions made by people who had been given enormous resources and no architecture for managing them. The money flowed out through the construction of mansions that cost fortunes to maintain, through social spending calibrated to impress rather than to build, through inheritances distributed to each generation without any of the structures that might have slowed the dispersal. One generation's extravagance became the next generation's reduced circumstances, became the generation after that's ordinary finances, until, by the 1970s, there was nothing substantial left. The families who avoid this outcome do not do so by producing perfect heirs. No family can guarantee that. They do it by building structures that account for imperfect ones. Incentive trusts that tie distributions to demonstrated behavior, the completion of a degree, sustained employment, the absence of certain defined problems. Governance councils that require consensus among multiple family members before core assets can be sold or restructured. Distribution schedules that prevent any individual from accessing the principal in a way that would expose it to personal liability. They plan not for the heirs they hope to have. They plan for the heirs they might. Number 14. They use philanthropy as architecture, not advertising. When Henry Phipps funded the Phipps Institute for Tuberculosis Research in 1903, he did not hold a press conference. When he endowed the psychiatric clinic at Johns Hopkins Hospital, there was no gala, no naming ceremony attended by the press. When he built the conservatory in Pittsburgh that bears his name and that continues to draw hundreds of thousands of visitors, his name was on the building and essentially nowhere else in public life. What Phipps understood, and what the most enduring philanthropic legacies tend to share, is a specific distinction between two kinds of giving. There is giving that serves the institution you are building, and there is giving that serves the moment of giving itself. The first creates something that functions without you. The second creates a record that you gave. Carnegie understood this intellectually, but found the celebrity irresistible. His institutions are real and enduring. The libraries, Carnegie Mellon University, Carnegie Hall, are genuine contributions that continue to function. But the personal fortune was dispersed within his own lifetime, in a very public race to give it all away before he died. The giving became the performance. Phipps gave quietly, built structures, and let the institutions carry the work forward. Bessemer Trust, which grew from the family office he established in 1907, continues today as one of the premier wealth management institutions in the country, managing capital for some of the wealthiest families in existence. His name is not on the door. His architecture is in the walls. The question these families ask about any philanthropic commitment is not, will people know we did this? It is, will this still be functioning in 50 years? The answer to the first question fades. The answer to the second is the only one that matters. Number 15. They never tell you what they don't talk about, because the silence itself is the system. We have spent this entire video cataloging things that old money families never discuss. Their wealth, their structures, their negotiations, their philanthropy, their influence, the way they raise their children, transfer their assets, signal status within their circle, and disappear from view outside of it. And perhaps the most important thing to understand is this. None of these families sat down and wrote these rules. There is no document, no handbook, no charter, no codified set of principles titled "The Things We Never Speak About." The codes exist because they were never codified. They were lived, observed, absorbed, and passed on through environment and repetition, not through explicit instruction. A child raised in these families does not learn rule number 1, they never discuss money in public. They simply grow up in a household where money is never discussed in public. The rule becomes invisible because it becomes the air. That is, in itself, a form of protection. You cannot teach what you cannot articulate. You cannot copy what was never written down. The imitator can reproduce the surface, the clothes, the posture, the brands, but cannot reproduce the environment. And the environment is where the actual transmission happens. John D. Rockefeller Sr. refused to respond to Ida Tarbell's expose for years, not because he had nothing to say, but because he believed that to engage was to legitimize. The greatest asset he possessed in that moment was not his money. It was his capacity to sit still while the world demanded an explanation and offer nothing. Henry Phipps walked away from one of the largest transactions in American business history with between $40 and $50 million and never once discussed it publicly. The Mellon family founded the National Gallery of Art, one of the great cultural institutions of the United States, and a family associate had to confirm to journalists that the family simply did not want their real net worth discussed. Richard King Mellon helped rebuild an entire American city and preferred to let his partner take the public credit. These are not coincidences. They are a pattern so consistent across families, across generations, across industries and continents that the pattern itself becomes the message. What the most durable families in the world share is not a particular investment strategy or political alliance. What they share is a structure of governance, of habit, of information management, built deliberately, maintained consistently, and never announced. The Vanderbilts did not fail because they made bad investments. They failed because they had no architecture, no ledger system for the children, no family office, no dynasty trust, no milestone-based distribution for heirs, no governance council, no mechanism of any kind to hold the whole thing together when it needed to be held. They had the money. They never built the system around it. Anderson Cooper, great-great-great-grandson of Cornelius Vanderbilt, said it plainly on a radio program some years ago. His mother had made one thing clear: there was no trust fund. The richest man in America in 1877. 6 generations later, nothing. So what does this mean for the way you handle your own finances? You do not need $100 million to apply these codes. You need the same thing these families built first, before the money justified it, before the fortune was large enough to demand a structure to protect it. Start the ledger. Not because you have assets that require sophisticated tracking, but because the identity of someone who accounts for every dollar is the identity from which larger wealth can actually be held. Practice strategic silence, not paranoia, precision. What you reveal about your financial position, your plans, your resources, shapes how others engage with you in ways you may not directly observe. Choose deliberately what you show and to whom. Build governance before you need it. A will, a trust, a conversation with the people you intend to leave resources to about what those resources require of those who hold them. The families who waited until the fortune was large enough to justify the structure usually found at that point that it was already too late. And when you give with architecture in mind. The contribution that builds something lasting, an institution, a fund, a framework that operates without you, outlasts every gesture made in the moment. The codes are not secrets. They were never hidden. They were simply never spoken aloud. And now you know exactly why. If this is the first time you have found this channel, what you just watched is what we do here. We take the codes that old money families live by, the structures, the strategies, the mindsets that separate fortunes that last from fortunes that fade, and we lay them out, clearly, with the families and the history to back them up. No shortcuts, no promises of overnight wealth, no advice that sounds compelling until the market turns. Just the long game, played the way the families who actually won it played it. If that is the kind of content that belongs in your library, subscribe now. It costs you nothing, and it ensures you will not miss what is coming. Because next, we are going inside a question that follows naturally from this one. We have talked about the codes these families live by, the things they practice and never speak about. Next, we are going to look at something more specific: how the families that stayed wealthy for a century actually built that wealth in the first place. The structural decisions made in the first generation that determined everything that followed. What they got right from the beginning, and what right actually looked like when the empire was still being assembled. That one is coming, and I think you will want to be here for it. God bless you.